The first quarter of 2024 started off with a bang. Capital markets around the world had very solid returns. European markets led the way at nearly 12.5%, followed by large company U.S. stocks at just over 10. Bonds were basically flat, but nearly every other asset class performed very well. As has been the case for the past 2 years, markets are moving based on inflation and what the Federal Reserve will do to bring inflation back to a more manageable level. Currently, year-over-year inflation is at 3.2%, which is still above the Fed's stated target of 2.5%. So we expect to see the Fed be less aggressive in lowering interest rates, given the resilience of the U.S. economy, which is a good thing. So what can a strong start to the year mean for performance for the remainder of the year? When stocks are up 10% or more in the first quarter, the final 9 months were up 10 out of 11 times. Yes, 1987, which was the infamous stock market crash, was the only time it wasn't. 1976 and 2012 are highlighted because they were also election years, like 2024, and only saw modest gains the remainder of the year. It's only 2 instances, but it's still something to pay attention to as the year progresses. For 10 straight weeks, the first time since 2017, the market has been in overbought territory, which means it's incredibly strong. According to JP Morgan, while this type of run of very strong momentum suggests we could be in for a pullback, previous runs have not been especially bearish. On average, all previous streaks since 1950 of 10 straight weeks being overbought saw the index 15% higher a year later. Although the economy is on solid footing, we do get several questions about the rising levels of credit card debt. It is true, credit card balances are at an all-time high, which does sound scary at first glance. However, this chart looks at the other side of the equation. Household assets, things like 401k balances, home values. The blue line represents household assets, which are at an all-time high. The white line represents household debt, which is also at an all-time high. However, the level of growth in household assets has far surpassed the level of debt, which indicates that household balance sheets are relatively healthy. The most important thing to consider when analyzing household debt levels is the consumer's ability to service or pay that debt. Given the unemployment rate is near all-time lows, wages are outpacing inflation, consumers appear to be in a great position to manage these debt levels. So we are not concerned about the doomsday headlines. To sum it up, we've had a great start to the year. Markets around the world are above or near all-time highs. Economic growth is outpacing the 15-year average. Inflation is moderating. The unemployment rate is low. We don't foresee any major areas of concern. With that being said, the stock market is expensive compared to historical valuation metrics. We need to see profits continue to grow to justify the premiums that investors are willing to pay for stocks at these levels. We continue to believe the U.S. will outperform international markets, but pullbacks and volatility are just a normal part of investing. Over the last 75 years, a 14% correction at some point during the year is perfectly normal. So remember to expect pullbacks and corrections along the way. These are signs of a healthy stock market. Thank you for watching, and please contact us if you have any questions.